Everyone, I'm Akhil Rathi here from Asit C.Mehta Investment Intermediates Limited. First of all, on behalf of ACMIL, the short form of Asit C.Mehta Investment Company, I welcome everyone for this web conference on Introduction to ACMIL Portfolio Management Services. So for today's call, we have a special speaker from Omniscience Capital, Dr. Vikas Gupta. He is a CEO and Chief Investment Strategist in Omniscience Capital. So just wanted to introduce Mr. Gupta. Mr. Gupta holds a BTech from IIT Bombay, MS and doctorate from Columbia University, New York. He also served as a scientist and professor at University of California and IIT Kharagpur respectively. Dr. Gupta is regularly quoted and interviewed and invited to contribute in global, US and Indian publications such as Seeking Alpha, Money Control, Mint, Economic Times, Wall Street Journal, Bloomberg and many others. Dr. Gupta has earlier incubated the global listed equities vertical at Earthveda Capital, which won the international awards and rankings. Besides, he obtained a US SEE license for the firm with a vision of catering to US clients in a compliant manner. He led advanced discussion and inked agreements with leading stock exchanges and asset management firms and research firms and across the globe, including US and Europe. So before I hand over to Dr. Gupta on this special topic of introduction to ACMIL Portfolio Management Services, I request please don't start your video. And if you have any questions during the Q&A round, please use the chat option. Thank you and over to you, Mr. Gupta.
Thanks, Akhil. Welcome, everyone. So on your screen, you should be seeing the screen I've shared, the presentation I'm sharing. ACMIL PMS, creating a supernormal portfolio.
Just 1 second. Please start once again. Start sharing the screen.
Yeah, sure. Yeah. So welcome everyone, and on your screen you should be seeing the sharing of the presentation which I put up. ACMIL PMS, creating a supernormal portfolio. So if someone has some problems, they can try to contact the host. Okay. So let's start. And typically when we are doing this, what we understand is that we want to make the highest returns, right? So that is what people typically expect from a portfolio management services. So we would like to clear some of the misunderstandings about PMS, as well as how we go about it and what is our philosophy of the equity markets and how to manage investments in that. So this is a very important chart according to us, and everyone is familiar with Sensex. This is end-to-end from day one of Sensex, how it looks, okay? And it's very important that you familiarize yourself with this because everyone knows that Sensex has gone up 330 times in 40 years. In fact, until a few weeks back, it was 400 times, right? And Nifty has gone up 10 times in 25 years. So most of you are familiar with this and you talk to other people about it and so on and so forth. So that's the good part of the markets. The other parts which we say and we just club under a term called risk, let us try to understand some of them. So if you go to this part, you will see no performance for 9 years, right? From 1991 at the center of the chart at the bottom. From 1991 or 92 until about early 2000, okay? You will see that if you entered at the peak in 91, 92, you were having zero performance over a 10-year period. And in fact, so post 2000 peak, again, if you had continued holding beyond that peak, you would have 11-year underperformance until 2003. Okay, so Sensex can underperform beyond for a very long time. Second, 3-year underperformance is quite normal. a significant fall. People, a lot of you do risk profiling or think about it. You say, yeah, 15-20% I can handle. But no, 2009, the fall was 60%. And in small caps, it was even more than 80%, okay, up to 90% probably. And we have seen that fall recently, right? From Feb to March bottom, it was a 38% fall. So this is what exactly is risk. And you have to imagine that you entered at the peak of 2008, and then you had a fall, and you were in small and mid cap as well as the large caps. You would be experiencing as if your 100 rupees is only 20 rupees or 10 rupees or 30 rupees. And even in the large caps, just 40 rupees. So 60 rupees gone. And you don't know that the recovery is coming. And you don't know how and when and how long it will take. Okay, every time you are at the bottom, you don't know you are at the bottom, or things could fall further. Okay, so keep that in mind. And then individual stocks. So this is fine. I mean, you will say, fine, I can handle, I've seen enough of the markets. That's and markets eventually recover, which is true. It's just that you don't know when. But individual stocks, many, and we are not talking about penny stocks and all. Of course, a lot of hundreds of thousands of penny stocks have gone to zero. So we are not talking about those unknown small-time companies, which might be not genuine. We're talking of well-known companies, the Yes Bank, the DHFL, Jet Airways, Unitech, and there are a number of many more such companies. And you can see how they became extremely popular, and then they've gone to zero or practically zero. So I'm not saying zero is exactly zero price, but it's a very low price. So you've lost all your capital most likely. And these are companies, many of these companies were in practically all the portfolios. Okay, a very large number of portfolios. So stocks can go to zero, markets can fall significantly, or markets can be below the capital value for a very long time. So now, having seen that, my question is, do you agree with these statements? Sensex has gone up by 330 times in 40 years. Nifty has gone up by 10 times in 25 years. Markets can go down 10, 20, 30, or even more than 70%. Markets can remain down for 1, 2, 3, or more than 10 years. You could lose all your money in the markets. Stocks can go to zero. And no person, no investor, including fund managers, can consistently enter the market just before a rise and exit the market just before a fall. So most people want the fund manager who will enter just before the turnaround from the bottom starts. So April 2009, they want the fund manager to enter. And I know a lot of them who claim they entered at April 2009. Okay. And then who sell off at the peak of 2010-11, and then remain uninvested until exactly let's say December 2013, and go on to peak at 2016, and so on and so forth. Okay. And there will be a lot of people telling you, oh, I exited everything in January or February and I knew it will fall. And but you ask them, were you inside in the market on March bottom? They say, no, I am still getting in, and so on. So there are people who claim, and it's in our opinion, this is not possible. If you agree with these points, then it's good. If you don't agree, then I don't think you should be in the equity markets. Now, a lot of people are familiar with these names. So on the left side is Benjamin Graham, guru of Warren Buffett. Then there is Phil Fisher. He is also guru of Warren Buffett. Warren Buffett himself, his partner Charlie Munger, and then Peter Lynch in the last. Okay. All great fund managers, and people claim that they follow these gurus. And this is what they understand, that Benjamin Graham was a value investor, and he bought low PE and low price to book stocks. Phil Fisher used to say buy great growing companies and hold forever. This is the learnings. Okay, Warren Buffett, buy the inevitables, moat companies. Charlie Munger says have concentrated portfolios, just 3 or 4 stocks is sufficient. And Peter Lynch says buy multi-baggers, 100 baggers. So do you agree with this? Now, unfortunately, I cannot interact with you as we could in a physical session. But most people typically think they agree with this. And I understand that this is what are the learnings associated normally with these gurus. This is in red below this is our view of this. So value investing, buy low PE companies, very good. But what about debt? Okay, there are many other questions, but what about debt? Okay, simple question is what about debt? Buy great growing companies, hold forever, very good. Do you think the great company will be great 20 years from now, 15 years from now, 10 years from now? On what basis? Okay, Warren Buffett seems to say buy more companies. Isn't it important what price you pay? Charlie Munger seems to say have a concentrated portfolio. We just saw that stock can go to zero. And these are not some unknown stocks, right? At least one of the stocks you would have said, and depending on who you are, different people will pick at least one of those stocks as a stock, which they would not think was bad. In hindsight, everyone starts saying, oh, I knew this company is not going to do well. I didn't buy it. I told everyone, etc. But one of these 4, in reality, most likely, many people had. And if that was a principal allocation, you know what would happen to the portfolio. Then everyone is chasing multi-baggers. I want the 100-bagger company. So the research shows that only 3 out of the 2,000 companies, only 3. And when that too, when you buy them at the bottom, and then you hold them for 25 years, then you make 100 baggers. Okay, so 100 bagger is not that I buy today and by end of 6 months or 2 years, I am sitting on 100. No, it takes a very, very long time. And during that period, the stock will fluctuate, etc., etc. And many of them will go to zero. So you don't know beforehand what's a 100 bagger. You can enhance your chances of a 100 bagger, but you don't know for sure. Okay. So concentrated portfolio and a 100 bagger is a problematic combination. So where are we today? So we'll just take a view at where we are today. Can you see the slide? I think we're having some...
yeah. So actually, your screen sharing is not working. So I'm sharing the screen from my side. You can tell me the slide number to change here.
Okay. No, let me give it a try. Just a second.
Yeah, please try. I'm stopping.
Reshare it. Or just give me a second. Yeah. So so some problems in terms of screen sharing.
Yeah, it's done. Yeah.
It's coming now?
Yeah, it's coming now. But please do full screen. Yeah, full screen.
Yeah.
Yes, done.
So where are we today? Okay. So this is the last 1 year. So last 1 year, we put down BSE 100, which is representing the large caps, BSE mid cap, and then the BSE small cap. And you can see this is end of May. Last 1 year as end of May 29th. BSE 100 is down by 19.5%. Okay, BSE mid cap is down by 21.5% and BSE small cap 26.7%. So last 1 year, you can very safely say that across the market caps, we are in bear market. Okay. Let's take last 2 years. So someone who entered 2 years back, on an average, their large cap portfolio is down by 12%, mid cap is down by 26%, and small cap is down by 37%. Okay, so 2-year holding, and you will say, oh, I am long term, I passed 1 year, this is 2 years, and you could be down as high as 26% or more. And then let's say where we are in terms of 3 years. So BSE is slightly negative, BSE 100. So even large caps, even today, on a 3-year holding period, which most people consider as long term, it's still down, it's still a capital losing proposition. Of course, you would have gotten some dividends, etc. BSE mid cap is 19%, so definitely bear market, or very close to bear market, and BSE small cap is 27.8. So in any other thing except the few large caps, you would feel that you have lost a significant amount of capital despite having held for 3 years. So 1 year, 2 year, 3 years. Okay. So this is when the risk in the markets start feeling real. And only if you can handle this and you say, I don't know when I'm going to recover, and it is fine, only then you should be in the markets. So this just gives you a feel for where we are. So ignore this. I mean, we think from March there is such a big rebound and 25-30%, whatever it is. And so it's great. Yes, absolutely, it's great. And despite that, you are down probably even on a 3-year basis in mid and small caps by 20% to 30% or more. Okay. And even on large cap, you've lost capital. Now let's look at what is called the Buffett indicator, the market cap to GDP ratio. We are today at the right hand bottom corner. You can see where we are today, which is at 54%. So you are at 54% market cap to GDP. The same number was there at the bottom of 2009, 54%. Okay. So we are at some similar valuation as far as this indicator is concerned. So this will just give you a fair idea of where we are. Okay. And naturally, any logical person can conclude what they or infer what they need to do right now. Okay. So you have to, this is the time to enter. Definitely everyone says 2009 was the time to enter. But now they will say, oh, I don't know, maybe it will go up, maybe it can go down again, or I don't know, maybe markets will take more than a year to recover or 6 months to recover. Let me just enter when it's going to turn. So which nobody knows according to us. Okay. Anyway, having established the uncertainties in terms of the ups and downs and mark-to-market values and so on, let's go to how you end up making money in the markets, because eventually the markets give you a return, right? We saw 330 times in 40 years for Sensex. How did that happen? So that is an average return of 15%. 330 times in 40 years is a 15% average return. Plus there are dividends of about 2%. Okay, so that's about 17%. So market, the average return is 15 to 17%. How does that come about? So is that the only way that number is coming, or is there something else? And this probably, so now we are sharing some logic with you, which you might not have seen anywhere else. Okay. So for that, you need to first figure out how do you get the bank deposit rates. So it's not that RBI says something and then the banks do that and then it comes about. No. There is a fundamental number underlying all this, which is inflation. And in the long run, in India, the inflation has been about 7%. So you add on 7% inflation, which means there is no increase in your purchasing power. So you gave 100 rupees to the bank and bank gives you back 107 rupees at the end of the year. You can exactly buy the same goods which you could buy 1 year back. So there is no increase. So why did you give the money to the bank? So you want something more. 7.5% you want as real returns, and that's why the bank has to, in the long run, not today, in typically on an average, bank deposit will give you something like an 8.5% when inflation is 7%. So suppose inflation is 5%, you are talking of 6.5%. Okay. Then arriving at the lending rate. Now, when bank takes money from you, it cannot magically give you this return. It has to earn the returns from somewhere. So effectively, bank is just a fund manager, and that fund manager is cost of their deposits is 8.5%. Bank's own costs is around 4%, and they need to lend at least at 12.5% rate. Okay, and only then they will be making profits. So that's the fund management and costs of a bank is about 4%. So they lend at 12.5. So when a corporate, who do they lend to? Typically corporates, right? For running their businesses. So when a corporate borrows at 12.5, it needs to earn something more on top of that. So let's say it's around 2.5%. So the corporate's return on capital needs to be around 15%. Only then it makes sense for the corporate to borrow. We have assumed that cost of return on capital is so when we say return on equity, it's similar to return on capital. So if you're making at least 15% plus return on capital, then your return on equity can be even higher, right? So that is why a company in India generates a return of 15%, and that is why the markets on an average give you 15%, because the return on equity of Indian companies is typically more. So there is no magic to why Sensex delivered 330 in 40 years, 330 times in 40 years. There is no magic to that. It is purely this return on equity and the reinvestment of that capital by the companies, and the reason being that our inflation is at 7%. If inflation was 5%, this 15 would become 13. If inflation was 0 or 2, then similarly this would be around 10% or 8 to 10%. Okay. So this is how the market delivers you returns. So it's not some magic or it's just a historical number. You can actually, and even if that historical number is there, you don't have to agree that that number will continue. You can arrive at your own estimates by using what I have shown you here. So that will include the inflation, banking costs, and the expected equity premium. So expected equity premium shouldn't change. Inflation in future could be different. You use that. Bank costs could be different because of fintech, and so your return on equity could be different or slightly lower, I would say. One more illustration of how you make money in the markets. So company book value, let's say starting, this is an illustration. Assume your company's book value on day one is 100. Return on equity is 15%, and it reinvests all the capital. So there is no dividend payout, etc. And 5 years later, the company's book value would be 200, because if you keep reinvesting 15% returns and at the same rate for 5 years, you will end up with doubling your investment. So the book value goes from 100 to 200. Now, when you buy in the market, typically you don't get a company at the book value. Let's say the fair multiple, fair price to book value for the company is 3. So the price of the share price of the company would be 300 today. 5 years from now, book value is 200, and you still sell at the fair price to book value of 3. Then price of company is 600. Your investment return is 15% CAGR, and you have doubled your money. So it's a 2-factor. Right? Now, illustration, buying at a discounted value. Okay. So now you're slowly getting into the buying things at a discount logic. And why? Say company trades at a discounted price to book. So maybe there is some reason why company is trading instead of the fair multiple of price to book of 3, it is trading at 2. So the price today is 200 rupees share price, book value is 100. 5 years from now, book value has gone to 200 from 100 because of ROE compounding. Fair multiple, you are able to sell at a fair multiple. So let's say the fair multiple, the price of the company share price is 600. Your investment return is 25% instead of 15%. And it's now 3 times instead of 2 times. So you have 1x extra. The economic return is 15%, still like in the previous example. Here what I illustrated. But the value return, in addition, you have what we call a value return, discount to fair value. That is generating an extra 10% per annum for you. That's why you get a 25% CAGR, and it makes a huge difference to your portfolio value, 2x versus 3x. Okay. So that is how you make money in the markets, normal money, and this is the alpha generating money. If you are able to consistently buy your portfolio of stocks at a discounted value, sell them at the fair value, you are significantly ahead of the markets. So very clearly, just to emphasize, nobody is saying that you will make 15%, nobody is claiming that you will make 25%. This is just an illustration. So what is the science of alpha from safety? So scientific investing creates a survive and thrive portfolio. Okay. Survive and thrive portfolio, which is a supernormal portfolio. What does it do? Why do you need survive and thrive? Because you have to navigate, your portfolio needs to navigate a lot of uncertainties. So fundamentally, the uncertainties are the economic uncertainties. So macroeconomy, GDP going up and down, wars happening, things going bad in terms of inflation, and many other things like a COVID crisis. So any number of things can happen in the real world, and that creates uncertainties. Then sectors or industries go through uncertainties, and even because of regulators or because of competition and so on. And then the specific companies have their own challenges. So because of all that, you need to design a robust portfolio which can survive, and a portfolio, once it survives, it should have an opportunity to thrive. So that's what we call a supernormal portfolio. And the objective of scientific investing is to deliver return on safety. So most people think high risk, high returns. This is our insight, Omni insight, that most market participants chase alpha, but what they get when you chase alpha is risks. While one could choose safety, if you chase safety in a very ironic manner or unexpected manner, you actually end up getting alpha. Okay, so this is an insight, and that is why we call this return on safety. Okay, so how it is delivered, we will now illustrate to you. So you are to be standing on the shoulder of giants to see further. And we've already seen some of the giants before. And this was said by Isaac Newton in terms of his discoveries. But this is what scientific investing is also based on. Okay, so we've gone through more than 100 years of investment management history, how practitioners have practiced, what empirical evidence is available, and then using that, trying to formulate our own scientific investing philosophy, and then running it into the markets, and then learning from that as well. So it's a culmination of all of this, what is scientific investing. And this is what we learn from the gurus, as opposed to what we showed you in the initial slides. From Benjamin Graham, most important thing is to have a margin of safety. From Warren Buffett, risk is loss of capital. Okay, that is what risk is, not volatility, not beta, not any of the other things. Charlie Munger, what you need to learn is moat investing rather than the concentrated portfolio. Okay. Phil Fisher, definitely you need to learn growth investing from him. John Bird Williams, his name was not there, but how to calculate intrinsic value, the fundamental equations he's developed initially, and now very sophisticated versions of that, much more evolution has happened on top of it. And the concept that you should buy at a discount to intrinsic value. And then from Peter Lynch, most people learn, the 100 bagger, which is very good, and then when you start chasing it, it is very bad. Rather, you should learn diversification. He had nearly 1,400 stocks in his portfolio. If you can believe that. It's probably, you will think it's bigger than the market, but at that point of time, US had nearly 5,000 companies listed. And even today, there are more than 3,500 companies listed on the US market. And I'm not talking about penny stocks. I'm talking investable companies. And there are many other investment practitioners and academicians who have contributed to this learning. So all of that culminates into scientific investing. Now pay attention how you create a supernormal portfolio. So in the era of disruptions and transformation, there are of course problems and opportunities. And that is why you need a supernormal portfolio which can survive and thrive. Now imagine the full market, and you of course have the option of investing in the full market, what typically people call index investing or ETF investing. But there is a problem. When you buy the full market, there are a lot of companies in the market which are troublesome, which you would not like to have. And the number one is what we call capital destroyers, companies which destroy your capital. And what are those kind of companies? So those kind of companies with weak business operations, loss-making companies, highly leveraged, which means a lot of debt, too much debt on the balance sheet. Those are the kind of companies you don't want in your portfolio. And I would say, when you say buy the full market, I would say, yeah, why don't you just take out the capital destroyers? And nobody would disagree with me that they don't want capital destroyers in their portfolio. And you would be better than the market. You're already ahead. Let's say 1 to 2% companies are going to zero. They're going bankrupt, and you've taken them out of the market. Then you are that much ahead of the market, right? Because that much of your capital loss is safe. So you are already safer. Your portfolio is cleaner, safer, and it is generating better returns than the full market. So you already have alpha if you just take out the capital destroyers. Second is capital eroders. So capital eroders are actually profit-making companies. They are even paying taxes. And you would say, yeah, I mean, I invest only in profit-making companies. These are genuine companies. They are paying taxes. Absolutely fine. But what is their return on equity? So we established in one of the slides that a company in India, a corporate in India, needs to generate at least 15% return on equity. Right, in the inflation era of 7%, long run inflation era. So if they need to generate 15%, and if you have a company in the portfolio which is consistently generating 6% or 7% return on equity, then what is it doing? It is eroding your capital. Okay, so these are called capital eroders, and you don't want them in your portfolio. So if you take them out from the full market, you have destroyers out, you have eroders out. I think your portfolio, not just I think, I mean, you conclude what you think, that you have taken out the risks from your portfolio and your returns should be higher, because no longer anyone is eroding your capital or destroying your capital. Okay. Now the last bit, capital imploders. So these are very high quality companies, but everyone in the market has priced it. They're available not at fair multiple, they're not available at discount, but they're significantly overvalued. Okay, because everyone thinks great things are expected from them, and they become more and more optimistic, and the models can lead them to higher and higher valuations. And if you keep extending and you say, okay, 20% ROE for 10 years, this is the value, 15 years, this is the value, 20 years, the value keeps going up. And you know the thing in compounding. So if I keep extending it to 25 years, 30 years, and so on, I can say this got infinite value. Okay, but reality doesn't work like that. There is economic competition, and the best of the best companies in some era, in a future era, no longer remain the best, right? So especially if you look at the US market, you can learn a lot, because the longer history is available, clear data is available, and General Motors was one of the greatest companies in 1950s or so on, 60s and all. And then 2009 it went bankrupt, and it's now another company, you should say, think what the current General Motors is. And again, it's probably going to be in trouble, probably, depending on the sector surviving or not. So that is what we call capital imploders, when a good company, the price is too high. So it is probably a supernormal company, but not available at a supernormal price. It's at a huge premium. So if you take these companies out as well, again, a capital imploding event is reduced in your portfolio. You are left with capital multipliers. With so much capital destroying, return destroying set of companies out of the full market, you're only left with capital multipliers. If you just buy this portfolio, it's a much safer portfolio and with much lower risks. And you're ahead of the market. So lower risk, higher returns. But from this capital multiplier portfolio, you could actually pick a set of supernormal companies at supernormal prices, which means at a discount to the intrinsic value. A diversified portfolio with sectors, multiple sectors in there, and no single company becoming a very large portion of your portfolio. That is what we call a supernormal portfolio. So this is the secret of our scientific investing. What are the sources of alpha? So let's understand 3 sources of alpha. Economic alpha, which we explained to you a little bit. So these companies can survive because they have a very strong balance sheet. So for example, if you are cash rich and today's situation last 2 months was a lockdown and you had 0 revenues and you had all the expenses. So despite having 0 revenues and all the expenses, because of a strong balance sheet, you were able to survive. And we have seen companies which could survive more than a year with 0 revenues. That's the kind of company you want, several months at least, if not a year. And then another part of a supernormal economic company is that it has a persistent advantage. Because of a persistent advantage is the reason why a company has high return on capital. And it should have a growth opportunity to invest in that. So that is where the economic alpha is coming from. The basic ROE, let's say, is 15%. You should have a company which can generate more than that. Supernormal prices, value alpha. So value alpha, again, from you as an investor, how will you survive if you are buying at a discount to intrinsic value? Then that's a conservative approach and more of your capital is likely to be safeguarded. Why it thrives is if you are able to get the true economics of the firm. If you have a deep understanding of business models, you can extract the true economics of a firm, which today are not clear. Just by looking at the net income or EBIT is not going to tell you what is the true economics. Okay, there are companies which are reinvesting for growth, and some companies are showing higher profits by using, let's say, less depreciation or whatever. So you have to extract the true economics, and then you need a superior valuation toolkit. Then you will be able to thrive in this part of it. And then supernormal governance, which is the portfolio alpha. So you need a superior allocation framework. Otherwise, if you have only 3 to 5 stocks, as we mentioned, and you don't spread it out across various industries, then you could be having trouble. And we saw in this fall, a lot of people who were heroes before this fall for 2-3 years, they're facing trouble now, right? And then to thrive, to capitalize on future opportunity, your portfolio should be rotated regularly, and it should have capability of investing in those companies. So to re-emphasize, company with ROE of 20% has an economic alpha of 5% compared to the average company of 15%, right? So if the average is 15, under the circumstance when inflation is 7, then if you have 20% average companies, you have 5% economic alpha. If you buy a company at 50% discount to intrinsic value, that we would call a supernormal price, and you would make 15% extra returns. So that's value alpha 15% per annum or CAGR basis, compounded annual growth rate basis, irrespective. So in addition, you would have the economic alpha. Okay, so I hope that is clear. Now we'll go to the ACE-Multicap, which is one of the core strategies of ACME PMS. Very, very briefly, I'll discuss that with you. So basically, India is the fastest growing economy even now across the major economies. So we pick from the liquid top 1,000 companies where the intrinsic value of the companies is more than 1,000 crores approximately. The scientific investing framework is applied to this universe and a portfolio of 20 to 30 companies. So on an average, you would have something like a 4% allocation to each. So around 20 to 25 companies with a 4 to 5% kind of allocation. And this is continuously monitored and rebalanced on an annual basis. Of course, you should have the risk appetite to go through the ups and downs of the market and then get the benefit of the capital appreciation. So we established that anyone, even with a 3-year horizon, you could be, the whole market is in a negative territory. So just to show that is our portfolio supernormal. Okay, we said we want to buy supernormal companies. So you look at the bottom fundamentals here first. ROE of the benchmark, which is Nifty 500, is 8.5%. Our ROE is 13.4%. Return on capital for the benchmark is 10. Ours is nearly 19. Okay, so definitely I think this looks like a supernormal portfolio. And on debt to equity, net debt to equity, it's 0.7 debt to equity for the benchmark, while our companies is minus 0.2. What that means is 20% of the equity is cash. So 20% unutilized equity exists, and that helps those companies to tide over any of those uncertainties like this COVID crisis. As I said, even at zero revenues, the companies can survive. And even in normal circumstances, any great opportunity arises, you have cash ready to do something with it. So we are not talking about the fund manager, us keeping cash. We're talking about the company keeping cash in their books so that they can do organic growth or they can do an acquisition or various other things when the time arises. So these are supernormal companies. Are they available at supernormal prices? So benchmark is 26p, ours is nearly 7p. Price to book benchmark is 2.2, ours is below 1. And look at dividend yield. Benchmark is 1.7%, ours is nearly 6%. Okay, so it is, in our opinion, supernormal companies at supernormal prices, and that is a supernormal portfolio. So ACE-Multicap, it's a pure equity portfolio invested 100% most of the time. Currently, of course, given the uncertainties and especially the economic uncertainties, I'm not talking of market uncertainties. Markets are always uncertain, but there is additional fundamental uncertainty of what will happen with COVID, when it will be controlled, would there be a second wave, etc. Would a vaccine or a treatment come about? It's still not clear. It seems to be taking much more time than expected. And so when the issues related to that come back, so we have opened up the economy worldwide, everyone has opened up the economy, but there could be surprises. So you have to be aware of those surprises and we should be prepared. And which is why at the portfolio level, if someone gives us 100 rupees, we are allocating it over a period of time. So about around 3 months we are dividing, okay, right now. And as we get the feel, we might change it a little bit. Normally it is 100% invested, but right now we are investing in 3 chunks. ACE allocator is when you cannot handle those severe ups and downs and you want them little bit mellowed down. It cannot be eliminated, okay? But this is a mix of debt and equities so that the falls are a little bit less and the gains are also naturally could be a little bit less, but there could be an extra source of alpha coming from moving from debt to equity. Okay, so what is that logic of moving from debt to equity is, as long as so this is Benjamin Graham's that an investment operation is something where the safety of capital and an adequate return is there. So we are targeting a good return but not trying to chase extraordinary returns with this. And equity portfolio remains same as ACE-Multicap, but the allocation of debt to equity keeps changing. So the idea is to avoid a Jan 2008 like bubble. And how you would do that is on any given day, uh, from time to time, you are regularly seeing the expected return from equities from the current levels over a 10-year period of time. And then you are seeing what is the return on the 10-year government bonds over a 10-year period of time. And if the equity returns are not, they will always be higher than debt. Okay. Most of the time on a 10-year basis, they will be higher than debt, expected returns of equities. But if that is not an sufficient excess to compensate you for the risk of equities, then we start shifting more and more money to debt. So the max allocation to equities is 75%, 25% to debt or cash, and the maximum allocation to debt, let's say we are at a peak of bubble according to our calculations, not according to somebody's feelings that, oh, I think we are at bubble. No, nobody's thinking. When you do a proper calculation based on market data and the expected return of equities is not sufficient, then debt could be as high as 75%. Okay, remaining would remain in equities. So this is the logic. And in an increasing interest rate scenario, we might go to cash or short-term debt. So this is ACE allocator. And then last one is ACE regular income. So the idea here is that let's say you wanted to survive on without any, just from your investments. Then typically I'll just take an average case that someone needs 1 lakh rupees per month. Okay, so they need something like a 2.5 to 3 crores worth of portfolio. And it is fine, it would generate net of taxes, etc. 1 lakh rupee per month portfolio. But 10 years later, if inflation is there at 7%, 10 years later, your 1 lakh per month is actually become 2 lakhs per month. And your portfolio is still generating 1 lakh per month, right? Because if you invested in fixed income of the 3 crores, you would still be generating 1 lakh. And so you now have to manage at 50% of your lifestyle, which is very difficult to do. So to kind of help with that kind of a portfolio, we have created ACE regular income, where the underlying is similar to ACE allocator, but we do a 1% payout of the NAV per month. Okay. So just a 1 crore portfolio delivers you an income of 1 lakh per month instead of a 2.5 to 3 crore portfolio. And that 3 crore or 2.5 remains 2.5 even 10 years later. And even 20 years later, it remains the same. While here, the net of the payouts, the remaining should be giving you returns. So this is the logic of this portfolio. And so I'll close the session now. Supernormal companies at supernormal prices. I need you to remember that. Scientific investing, enhance your safety, and that will enhance your returns rather than chase returns. Idea is to invest in the stars of the future. Avoid the herd portfolio. Don't buy the popular companies because everyone knows about them. What is on TV is there because someone is trying to sell you that company. Okay. I mean, I'm not saying every discussion is like that, but you have to be skeptical investor. You have to think like that. And you see why you want to buy it if you still want to buy. And you want to avoid permanent loss of capital and avoid overvalued stocks. So while you want a growing portfolio, you want growth companies, you don't want to have overvalued stocks. This is just our recent coverage. So Money Control covered Asit Mehta. 3 of the schemes of Asit C.Mehta, 2 large caps, 1 mid cap were in the top 10. So just sharing with you. Thank you. And now I think we can go for the question and answers if people have queries. Yes.
Okay. So if anyone has a question, you can use the chat option or you can raise the hand. We will unmute you. Okay, I've got one question. Sir, what is your view on consumption sector? What is your view on consumption sector?
So consumption sector this year, or at least the first half of this year, is going to be little bit challenged naturally because of we know the health crisis and that the consequent impact on the economy, right? Having the close down, so the buying power is reduced significantly, and there could be a little bit unemployment as well, not just at the lower levels. Many companies are realizing that you can work from home and maybe all the stuff is not useful, right? So all the who's contributing what is getting clearer. So there could be a little bit of loss of jobs or uncertainty in whether someone will keep a job, and that will reduce the buying power for this year, in our opinion. In the long run view, of course, consumption will be back, but the valuations typically available for consumption companies, even without any uncertainty in a good growth economy, it doesn't make sense to us. So with the uncertainty, we think definitely it's not worth it.
Okay, the next question is from one of the participants. So, one second. Which sector one should look in the current situation for long term?
So one sector we have been very clear from a very long period of time, for several years, is the IT sector. Uh, I think the IT sector is exposed globally, including to India, but primarily, offshore economies, developed world economies. And there is a huge opportunity, which is the transformation. So the business transformation or technology transformation. So these disruptive technologies such as cloud, big data, analytics, Internet of Things, IoT, artificial intelligence, all, or cybersecurity, blockchain, virtual reality. So all of these technologies are transforming the world of business as well as the whole economies, and it will be significantly the economy. I mean, you see how the economy was 10 years back in India or 20 years back and what it is today, right? How much you're buying online, how much you're using your apps to manage your transportation, travel, food, uh, everything. And now look at this. So what happens is when there is a trend like technology transformation and there is a crisis, something like what has happened, that actually accelerates that trend. So this business transformation or digital disruption or digital transformation, the whole theme has now accelerated. Indian IT companies are getting inquiries from their US clients because of their work from home requirements, that now, can we accelerate move to the cloud? Can we put IT infrastructure so that people can log in safely? The full security is available and the full bandwidth and full, IT infrastructure is available at their employees' homes. So can people work from anywhere? Okay, so all of that is a huge transformation projects. And similarly, can they reach their customers anywhere? Okay, not just that the customer has to come to a company outlet, right? So online sales, a lot of US retail companies used to be store dominated, store centric. And now because of the lockdown, many of them have moved to significantly online sales. And that trend is accelerated. Earlier, it was something nice to have. Now they've realized it's an essential. So that huge opportunity, and it's not just an opportunity because of the crisis. I mentioned that's an opportunity, it was already there. Crisis has just accelerated the move to that. In our estimation, our research, and this is supported by a lot of other very good consultants like World Economic Forum, Accenture, McKinsey, etc., Boston Consulting Group, etc., that this theme, this trend of digital transformation is expected to last for more than 10 to 20 years. Okay, and you're getting these IT companies at a very, very reasonable valuation, absolutely supernormal companies. And fortunately for us, the market has still not realized, and so they are available at supernormal prices.
Okay. The next question is, what is the general logic of fair price to book value? How does it change with the nature of business? What is the fair price to book value?
Yeah, so I have no idea. I have given an illustration there of a price to book value, right? You cannot just judge from price to book value. Price to book, price to earning, all these multiples based valuation methodologies are rule of thumbs. Okay, they are not actually valuation methodologies. And absolutely it changes from company to company, sector to sector, industry to industry. But not just in a specific industry, even within an industry, a specific company, based on the opportunities it has, based on the persistent competitive advantages it has, there is a difference on what is the particular multiple. The multiple is a result of a sophisticated valuation analysis. When you do a detailed valuation analysis, the outcome of that is a price, and then you divide that by the book value, or you divide it by the earnings, and you will get the fair price to earnings or book value for that particular company. It's very sensitive to what inputs you use, so you have to be extremely clear. You don't have to make aggressive assumptions on the future, and so on and so forth.
So we have last question. Should clients can invest in the current situation, or should they wait for next 3 to 6 months?
No. I think they better start investing now to handle the uncertainties. Is why, as I mentioned, that we would divide the current 100 rupees. If anyone is giving us 100 rupees now on a fresh portfolio, we would divide it into 3 chunks, approximately 1/3 each. And even there, next month we will take a call. See, rather than the investor who's busy a lot of times and who just reads headline level news, uh, and then if you are doing that, you will never know when to enter. We don't know when to enter, as in the timing. Let me be very clear. We don't know what timing. We don't know that, okay, today is the bottom, and so I'll invest the client's money and our own money, and it will go up from starting tomorrow. We don't know. No one knows. Let's be very clear. Uh, the best of the best investors you see on TV or hear their names in India or abroad, nobody knows. Okay. So what we are trying to say is, but we are more scientific, we are less emotional. This is what we do full time. We are looking at the companies, all the companies in the market on a monthly basis approximately. So we continuously look at our portfolio companies as well as what is not in our portfolio, but could be a interesting. So throughout the market, so we don't have a handful of watch list companies. We look at the whole market, approximately every month. And so we would get to know what we shared, that while on a headline level, it looks like the large caps are doing fine and Nifty is up and Sensex is up. When we start looking at BSE mid cap and small cap on 1, 2 and 3 year basis, in all cases, it's more than 20% to 30% or even more down. Okay. And that means that, and then I showed you the Buffett indicator. So this 3 months, 6 months, I will wait and watch. You will not be able to do. This is the bottom. It is similar market cap to GDP as March 2009. Okay, this is also at that kind of levels. Beyond that, after you enter, can it fall further? Of course it can. We don't know, which is why we are dividing into chunks, and it could go up as well. But we are not crazily, chasing high returns. We, as we said, first we chase safety. In the long run, that translates to probably beating most of the other fund managers and the market.
Okay. So we are closing this web conference now. So I thank Mr. Gupta for his valuable time and explaining about this introduction on to ACMEL portfolio management services. So if you have any queries, if you want to know more about the product, you can email at on pms at acm.co.in, and also you can contact Sandeep Shekhar. The details of Sandeep Shekhar is given on the emails which is sent to you. So thank you everyone for joining.
Thank you.